Welcome to the Women and Wealth podcast with Esther Szabo. Esther is a respected leader in the field of personal financial advice with over 25 years of experience. After going through her own significant and challenging life-changing events, she overcame fear and self-doubt to launch her own successful advisory firm. Now Esther is ready to share her practical and personal experiences to help other women clear their hurdles and brave life's transitions. In this way, she inspires women to lead fulfilling and confident lives.
Hello and welcome to Women and Wealth with Esther Szabo from Gates Pass Advisors. Today we're talking about year-end stuff because stuff is important and year-end is great. Hey, Esther, how are you?
Good stuff is important and year-end is great.
That's right.
These are important things, though, that we'll be talking about.
All right. So I know that this podcast comes out probably early December, if I'm not mistaken, correct?
Mm-hmm.
Somewhere around there?
It comes out, I think it'll come out this middle of the second week of December, to be precise, and that's what us planners are. We're precise and detail-oriented.
Absolutely. That's great stuff. Anyway, so we want every listener to pay attention because these are things that you can get accomplished before the end of the year, even though you have only a couple weeks. There's a lot of stuff on your plate. We understand that, but Esther wants to bring this to you right now. And without further ado, let's hit it, Esther. What do we got?
Yeah, I want you all to be aware there is time to take care of some of these things, but if something here resonates, move on it right away because it is a busy time, not just for you, but also for all the firms that you'd be dealing with to get these things done, and or your tax preparer too, if you want to run some of these things by him or her. And the first thing I want to talk about are these IRA Roth conversions. And that is the ability to take your balances or a portion of your balance from your traditional IRA. It could be an IRA rollover, a contributory IRA that you made the deductible contributions into for many years, or a SEP IRA. Those are examples of traditional IRAs. And you can take that money and move it to a Roth IRA. You would have to pay the tax now at your ordinary income tax rates, but there's no income limitation for conversion. So if you wanted to contribute to a Roth IRA, you have to stay within a certain level of adjusted gross income. But to convert to to a Roth IRA, there's no income limitation. And why would you want to pay tax now? Who would want to do that? It's because with the Roth, there are some very good benefits. The thing that is the same between Roth IRA and traditional IRAs, anything within the Roth IRA grows tax deferred. But a couple key things are different, and they are great tools for planning for retirement or when one is in retirement. One of the biggest things that I have come across over the years, and it seems like it's a great problem to have, but with a traditional IRA, once you get to age 70 and a half, and there's legislation before Congress to move that age to 72, but right now it's 70 and a half, one is required. You have to start drawing out the money. And there's a calculation that we do to determine that. And whatever amount of money is drawn out is taxable because the government wants its money. So what I find often enough, not always, but often enough, is that clients don't need that money to live on. They wish they could avoid taking that distribution. And one could give it to charity, but if you need a portion of it to live on, and then it's a little hard. Most people don't give that size gifts to charities, so it gets a little complicated. So they take the distribution, but it does make a difference in their tax liability. With a Roth IRA, once you've had the account funded for 5 years, you can withdraw the money at any time, tax-free. Plus, you're never required to make minimum distributions. So it is a great tool for planning. Those clients where we started doing this way back in the late 1990s when it first became available, we've got a great tool as we're dealing with financial planning and retirement. Which pool of money do we want to pull from? The other thing that's really beneficial is that when one passes away, if you pass away and your beneficiaries receive your IRA and you are over age 70 and a half and taking your required minimum distributions, again, out of your traditional IRAs, your beneficiaries also are required to start taking distributions as well. And this legislation before Congress now, part of it is that they must take it over 10 years, whereas under current tax law, they can spread it out over their lifetime. If they received a Roth IRA as inheritance, there are still mandatory withdrawals, but those withdrawals are tax-free. And so it reduces a huge issue for beneficiaries of having additional taxable income. Again, this does fall under the nice problems to have category, but they still can cause problems. So,
let me ask you a quick question. You may have said it. I might have missed it. When you convert from a traditional IRA to a Roth IRA, that doesn't count as income, does it?
It's all... You do have to take that amount as income. So if you took money out of your traditional IRA to convert to a Roth, let's say you took out $10,000, that $10,000 shows up on your 2019 tax return as income.
As full income. Okay. All right. So that's definitely something to consider. Anybody listening to this, you definitely need to consult a professional to see what is best for you. If you don't have a competent professional, contact Esther.
That's right.
She can answer all these questions. All right. Sorry, I didn't want to derail it. But
it's
all right. What else do we need to
know? There is discussion that the benefits for Roth IRAs may be legislated away because we are facing large budget deficits. However, there's nothing in front of Congress currently to do that, and we still recommend the Roth IRAs and doing these conversions, but they do have to be planned because there's a certain amount that you might be able to convert, and it really doesn't change your tax picture. So this is a good lever to look at. The next is, we've been in an economic expansion for 11 years. And so depending on how you count it, 10 to 11 years. And especially with large cap U.S. stocks, if you've held it for that long, you will see some large gains. And it's possible, you might need to rebalance your portfolio and take capital gains, or it just may make sense that you want to take some of that money off the table. So it's not widely known, but if you're in a lower income tax bracket, there's a long-term capital gains tax rate of 0% for those in the 10% and 12% tax bracket. So that is not widely known. To put dollars to those percents, because a lot of brains, it's like, what is a 10% bracket?
Yeah.
If you file as a single filer, that means you have a taxable income of less than $39,475 in 2019. And if you file married filing jointly, that is income of less than $78,950. And in some cases, that's where people's income levels lie. And it's important to say, well, shoot, let me see if I can take advantage of this right now. I have one client who is in this situation, and she is a divorced mom. And she's now a grandma. It's so exciting because when I started working with her, her kids were like preteens, and now she's a grandmother. It's just crazy how time flies. But we look at this when I'm recording this is in the middle of November, and we're starting to look, but it's still, once you hear this, it's not too late. If you have a portfolio that has mutual funds, you need to look at what those mutual funds will be distributing in the form of capital gains, because those count towards capital gain income amount also. And the way you do that is, if it might be at, I'm going to pick on Vanguard as an example, but any mutual fund family or mutual fund, you can look up online and see what their estimated capital gains distribution amount is. You may need to do some calculations. They may say something like, we're going to distribute capital gain distribution of $1 a share. So if you have 500 shares of a mutual fund, that means that you will have $500 in capital gains income in 2019. And that is true whether you choose to reinvest that distribution or take it in cash. Either way, it's taxable to you. So if you are, maybe you have 28,000 in taxable income without your capital gains, you might say, I could take up to $10,000 of capital gains and not have any additional tax liability on that. That's pretty cool because, again, that's the capital gains amount. That's not the amount of actual dollars that you could receive. So using that $500 example, that's $1 per share. You get a $500 capital gains distribution. But if you sold an asset for a $500 capital gain, it could release maybe $5,000 of an asset to you. So it's really important to check with somebody if it's not clear, but check with your tax advisor. Or again, I'll give you my contact information at the end of this podcast.
Fantastic.
The next area that I want to spend some time on that often, again, it's the end of the year, you see the Salvation or hear the Salvation Army bell ringers. We all get inundated with mail. I have a client who loves to come in and show me how many he collects all of his requests for charitable donations, and he brings them in and we go through which ones do you want to donate to. We have a actual charitable plan. So we've got all the ones listed out and how much we plan to give in a year. And we go through and we keep track of how much he's already paid in to that particular charity for the year. So he can feel guilt-free about letting those things go. But he does make a point of, gosh, you read these things or see these things and you feel terrible about putting them in the recycling.
Yeah, they don't use the nice, happy pictures, do they?
Especially the animal ones.
Oh, this dog only has one leg left. Oh, we can buy him new legs. Sorry.
But if you didn't send a check, he'd be pogoing around without you.
That's right. Captain Dan's got new legs.
But so often this is the season of charitable giving, even though charities do need your charitable gifts all year long. But there's a couple, I just want to give a little bit of history of charitable giving. And this is there's a podcast called Planet Money. You may be familiar with it. They also have a newsletter, and they had some really interesting information on the history of charitable giving in a latest newsletter. And I wasn't aware of this, that the charitable gift deduction dates back to 1917, so a little over 100 years ago, when tax rates were increased. The government needed to raise more revenue during World War I. So prior to the increase of tax rates, the top rate was 15%. And after the increase, the top rate was 67%. Ouch.
Yowza.
So there was a real concern that the wealthiest givers, you know the names, Andrew Carnegie, John D. Rockefeller, there was a concern that they would stop donating because their money, so much more was going to income taxes. So at that point, the tax deduction of charitable gifts was created. So spin it forward to now, we've had a recent tax law in 2017, so 100 years after the charitable deduction came into play. We changed tax law, and that went into effect last year, 2018, with the new rules. And in 2018, there were some changes that really impacted how many taxpayers are donating. So before I go into that, let me just talk a little bit about charitable giving. One can take a deduction off of income tax for the amount of the charitable gift, depending, and I'll come back to that depending part, so stick with me. But sticking with the theme of large cap U.S. stock has done very, very well. If somebody doesn't want to pay the capital gains income tax, but has charities that they really love to support, one can donate appreciated stock or mutual funds, or also generically called securities. One can donate appreciated securities either directly to that organization. Again, you have to get right on these because They go on vacation too. They want you have to make sure this goes through. There's a lot of requests going on. So you need to get right on this because of the volume. But you can donate appreciated securities. So using my example where you might get $5,000 and pay $500 in capital gains tax, for example, if you didn't want to pay the $500 in capital gains tax, rather than give cash, give $5,000 in the security directly to the charitable organization. And you can do it directly. You have to contact them for how to do it. It's done regularly, so it's not a big issue. Or you can open what's called a donor advised fund, which I love these tools. These are where it stays, you get to make up your name. Mine is called the Szabo Weber Giving Fund because it's charities that both my late husband and I really supported. And you can open that. There's a minimum typically of how much you start it with. Typically, it's around $10,000, $5,000 to $10,000. And there's a minimum amount that you can gift out of it. So that could be, say, $250. So be aware of those before you move forward on that. But with the donor advised fund, you put in your appreciated securities, or however you want to fund it. I often recommend using appreciated securities. And then that is when you get your deduction. It is not when you gift it to your charities from there. So I can just put funds into the Szabo Weber Charitable Giving Fund, and it's deducted that year. And then I have the whole year or the next 5 years or the next 30 years to decide where I'm propelling the money to or deploying the money. That's the word I want.
Yeah, and I've spoken with people before about this specifically, and one, just not trying to sway the audience here, but if you give to a charity regularly, which one thing that comes to mind is churches, people that give to churches on a regular basis with their tithe or their offering, you can actually do this, plan it out, what you normally would give for that next following year. So 2020, go give it to the donor advised fund in December. You're still giving on a monthly basis to the church all through 2020 as you see fit and as you would normally do. But then you get all that tax break for 2019. And it's especially great for people on the edge, right? Of whether they're taking the standard deduction or
itemizing.
Or itemizing, absolutely.
So you stole some of my thunder there, but it's fine. I'm glad.
I'm sorry.
Eric, because that's called lumping and clumping. So it's called lumping and clumping, where it is when you are right on the edge. So let's talk about this a little bit, because with the change in tax law that went into effect 2018, the standard deduction doubled. That's the deduction that is automatically available to you versus itemizing deductions, which is where you can say, okay, this is how much I spent on medical. There's a percent that I can deduct, possibly. This is how much I spent on state and local taxes. There's a cap on that of $10,000 now. This is how much I spent on charitable giving. Those are the three primary areas. And this is how much I spent on mortgage interest. That's the other one. For those that don't have more than the standard deduction amount to itemize, then you take the standard deduction. And so with the doubling of the standard deduction now, and I'll tell you what those amounts are. If you file singly as a single person and you're under 65, it's $12,200. If you're over 65, you add another $1,650 to that. And if you're filing jointly, then it's $24,400, twice as much as for a single. And if you or your spouse is over 65, you get to take $1,300. If you're both over 65, you get an additional $2,600. So before the age 65 bit, let's say you're married filing jointly, you automatically get $24,400. If you are, when we talk about being right on the edge, let's say between your mortgage interest and your state and local taxes, you are right at, say, 20,000 or 20,000, and you would normally give $3,000 in tithe or to your church or congregation. You might want to clump in the $3,000 or $4,000 that you would give in 2020 into 2019, so that then you can be over that standard amount. And that's not I didn't give a too exciting example there that would make that big a difference. But what we've done with some clients is look at this and go, let's do 5 years worth of deductions this year and make it a really big difference in terms of taxes for this year. And that requires just planning to look at that and say, okay, can I do without this particular asset for that long? What does that do in terms of income planning and obviously the tax savings? So that is something to really look at, that strategy. And again, there is still time to do it, but you do have to get on it and take a look. Since with the change in 2018 tax, with the 2017 law that went into effect 2018, we saw the largest decline in charitable giving since the Great Recession because of this change in standard deductions. So 20% fewer people are itemizing. And with that, it's like, well, why give? And for all of these things, anything with financial planning to do with taxes, whether it is making a change in portfolio or giving, it's always wise to absolutely look at the tax expense, but consider with investments, we say don't let the tax tail wag the investment dog, which means don't hold on to an asset because you just don't want to pay the tax because you could be opening yourself up to more risk. And the same with charitable giving, make sure it's aligned with your personal values as well as the income tax planning.
Yeah, absolutely.
So we have a little bit of time, or do we, Eric?
We do. We actually do have a little bit of time.
Okay, as a little bit of time, I'd like to change gears a bit to some non-financial. When we work with clients, we're experts in working with both the technical aspects of planning as well as the personal aspects of planning, and both are key. And I want to spend a little bit of time on a personal year-end planning note, because for many people, it's a really busy time. Is it busy for you at the end of the year, Eric?
Oh, just a wee bit, yeah.
What kinds of things
definitely
are going on in your world at the end of the year?
My wife loves to make plans, and she drags me to all the plans.
That's what we do. We make plans for our husbands. It's a hobby.
And, I love it. I mean, it's a lot of get-togethers, a lot of year-end stuff for my own business. It is just busy. I've got grandbabies that I'm going to be spoiling the snot out of. So, I've got plans.
Yeah, there's a lot to do. And I'm not even going to get into gift giving and budgeting and all of that. But that's always important too, to sit and make sure that you're okay. I guess I can't help but get into it. But to just a note to looking at the giving and making sure that whether it's charitable or to family or for meals and gifts, that it really is still aligned with your personal spending plan. So I will put a note in about that. It's so easy to sort of say, oh, it's the holidays, let me just do all of this. And then one goes into January and gets the credit card bills and starts off with a funk. And we don't want that. We want to start your 2020 feeling great. So to help that, we work with people in transition, women in transition, and it's so easy, just even if one isn't in transition, it's such a busy time. People are walking around with colds and flus. All of us have typically extra work and extra duties. Even if we love seeing our families and look forward to being together with them, it means getting the house ready, getting the meals prepared, getting gifts, decorating, all of those things. And it's easy to get fatigued. So I just want to put a note to plan into your calendar, as well as these important planning things, to take time to plan in to get those rest buffers. Self-care is really critical. It's so important. And if one is in transition, it's very, very normal, if this is one's first holiday season without one's spouse. I also, I can use myself as an example. Going through the holidays without David, the initial ones, it was really challenging and weird. And it was so important. I have this on a podcast, previous one also, but it bears saying again, to really have the people around you who really feel good and nurturing. Even if it means saying no to a lot of invitations, that's fine. Especially women, we don't like to say no. But you know what? It's okay. because it is so easy to get fatigued. And again, we don't want you going into January feeling exhausted. There's a lot more decisions to be made, and we want you in the best possible frame of mind and self-care. And that includes things, you were teasing me about this before we started, but it includes things like eating well, washing your hands frequently, because there are colds and flus that go around.
Hey, now the audience is going to think I don't believe in washing hands. That's not. I do believe in washing hands. Now, soap is optional, in my opinion. Okay, never mind. I'm kidding. Please use soap. Don't come away from this podcast saying, "Oh, I don't have to use soap anymore."
And do you sing "Happy Birthday" to yourself while you're washing your hands, so you know
Only
how long
when I brush
to
my teeth, but it makes the mirror messy. It's just terrible because I sing out loud, really loud, so it's just odd. But that's me.
But that's, to take care, because so many people, I can't stand it, walk around with colds and flus, and they don't, because we're all in this society where we have to work, and we don't feel like we can give ourselves that downtime. But so take care of yourself. And the other thing, Anasuya Basil, if you haven't heard her 2 podcasts on my series, go back and listen to those. Those are more about, but they're also critical. They're about how to handle excess sugar and things like that. And she calls this season of the holidays, it's the sugar and flu season, because starting with Halloween, the sugar intake goes up, and with increased sugar, one's immune system declines. So I would really recommend listening to those podcasts, and you can go onto her website, mybodywisdom.net, and she's got a blog post called The Art of Beating the Bugs, and how, supplementation and other practical recommendations for navigating through cold and flu season well. And I
she was a
really want to
fantastic guest.
She was a really good guest, and she has great practical suggestions. And her podcast, you can listen to it about her journey through transition as well. So
all right. What else do we need to cover today?
That takes care of it for today, I think. I would just invite people to, if you'd like to set up a complimentary meeting with me or talk with me about what your concerns are, you can go to gatespassadvisors.com, go to the contact page, and you can enter your information there. And you can also sign up for my newsletter. It goes out every 2 weeks. It's got the link to the most recent podcast, as well as some really interesting brief pieces on behavioral finance about decision making that are really, really intriguing and very pertinent to today's news.
Fantastic. Esther, amazing as always. Thank you so much for taking the time. And I hope everybody listening takes the advice from earlier, which is anything that you've heard in this podcast that you have questions about, reach out to your advisor. If you don't have one or don't have one that you feel confident in doing that with, please reach out to Esther. Esther, what number should they call again?
Our office number is 650-797-0280. We're in Northern California, but nobody uses the phones anymore. But you're welcome to call, because you'll get right through, because people don't call anymore. And the website is gatespassadvisors.com.
All right. Fantastic. And thank you all for listening to the Women in Wealth podcast with Esther Szabo. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Esther comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. And I'm going to say it one more time. Please share this one today. I'm hoping that this popped up on your listening device. I'm hoping that you've already subscribed. And as you listen, you say, you know what? I know a few people that need to hear this year-end stuff before it's too late, so they can make an impact on their 2019 going into 2020. They can always do it next year also. However, let's help them out this year. What a great Christmas gift. Again, thanks so much for listening today. And it's a free Christmas. You don't even have to wrap it. Isn't that fantastic? Yeah, we're saving the planet. No papers being used. Right. No ribbons were hurt during the production of this podcast.
That's right.
Again, thanks for listening today. For everyone at Gates Pass Advisors, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Women and Wealth podcast. Be sure to subscribe to the podcast so you receive notifications of new podcasts as they become available. Check out the website at www.gatespassadvisors.com for more information. This content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security.